Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Drew Meredith, how you going?
Great to be here as always. Always such an open, like an energetic opening.
Yeah, it is. Yeah,
Good to be here.
Bring the energy, Drew.
Exciting.
Bring it up. Here we go. 2 cents.
Nearly ready to head off. I'm actually, at the time of release, I'll be heading to the airport, I think. What time do you release on Saturday mornings? Yeah.
7.
7?
What time do you release? 7 a.m.
9:25 a.m. 8:45 a.m. NZ4.
What numbers and letters are you throwing at us? What are you talking about?
Yeah, New Zealand, off to Huntington Beach.
Oh, right. Yeah, I know you were going, but NZ4. All right, that's the target, guys.
Go meet the Ritholtz boys.
Yeah, that'd be fun. Of all the Ritholtz Wealth Management Illuminati, which one would you want to share a Negroni with?
Oh, share a Negroni? It'd have to be...
like as if you handed them your glass, like you actually shared the actual Negroni.
Josh Brown.
See,
just for sheer how bombastic he is. If I had to say who I was similar to, it'd have to be Batnick, wouldn't it?
You reckon?
I feel like you've got more of the annoying voice, like Ben Carlson. Oh, we're live, aren't we?
Well, I'm going to send this to him. No, but so for those of you that don't know, the Ritholtz Wealth Management crew are hosting an event. How does it work, Drew? Because so Ritholtz Wealth Management has started with Barry Ritholtz, Downtown Josh Brown, Mike Batnick,
Ben Carlson. Yep.
And basically what it is, for folks that are unaware, it's like a big media brand that's also a finance brand. So you invest with them and they can manage your money, but they've got these amazing podcasts. And one of the things that spin out of that 2 and a bit years ago, was like a big event that they run called Future Proof. So have I got that right, Drew? Is that how you would describe it?
Yeah, exactly. I think they were all in financial advice or wealth management before and started launching these blogs and podcasts. I think they're like 10, 15 years, maybe 10 years old now. Josh Brown and Barry Ritholtz were always on Bloomberg, so they're always involved in the media. And then they've just become huge. So the Compound Show or the Compound Friends and Animal Spirits, which we've listened to, both of us, I think, for a long time. And he's right. I think they've seen, similar to us, that like there hasn't been much disruption in advice and in investment, same as you. And Future Proof is basically the biggest wealth, they call it a festival in the world. It's like a trade show and a conference for financial advisors. So 3,000 advisors, I think 60 to 70 from Australia, and heaps of different service providers like fund managers, fintechs, back office solutions, big presentations, live podcasts, pizza making, candle making, some kind of, breakout events too. There's quite a few. I think only 3 Australians went last year, and there's about 70 going this year.
You guys, through your other business, which is the Insight Network, yours and Jamie's, that business, you guys are now connected to this somehow, right?
Yeah, so we're helping grow Future Proof in Australia. So it's like I believe there's an agreement that most of the kind of bookings for Australian advisors can come through us.
Oh, right. Okay.
Yeah.
Cool. That's great.
It was so eye-opening when we went there. Like, it's like going to a proper technology conference in Australia, and in probably most sectors, there's very little that's like innovative, like rethinking what we're doing. And the more people you talk to, very much a lot of industries are all about maintain the status quo, but this is really challenging, thought-provoking, and very focused on how do you the client or the user experience for financial advice and investors.
Yeah, cool. Well, that'll be fun. So basically, that's all code for Junket.
Junket, pretty much.
Yep. Okay, got it.
Let us make that before. I had to book in our recording while I'm over there just to make sure I was doing some work.
Yeah. So we are doing our call so we're going to be joining you live from Huntington Beach, right?
Yeah, somehow. The mechanics of that we haven't quite settled on yet, but maybe by the pool with a
Miami
Vice in there.
You just walk around with your iPhone and just say good day to people, and all of us back in Australia can just partake in the reveling. But we are going to talk about self-managed super funds today. We've got a heap of questions, which is good. Bring the questions. I love the questions, as does someone in the questions who said that they also love the questions.
Some good names too.
One name that shall be redacted from the list. Their question name will not be said out loud. But Drew
rhymes with no, we won't do
that. But Drew, seriously, what have you been working on this past week that other than preparing for your junket? I heard you went on another junket. Is that correct?
No, I was meeting. It depends on your definition of a junket. Yes, I did go and meet some clients and prospective clients this week, and was lucky enough to get a tour of the 4X brewery, or at least part of it, the packaging and bottling part, and just so they're owned by Lion, and just seeing how much technology has changed in 10 or 15 years. The level of speed at which bottling and the minimal human intervention that goes into it. Because if you think sales of beer are slowing, so how do you make sure you're as profitable and efficient as you can be in a more mature market? And it was quite unique.
Why are sales of beer slowing, in your opinion?
Carbs.
You reckon? I'd always come back to carbs.
I mean, you could say people are more health conscious. I think a lot of things have taken off. Like, you only have to go to Dan Murphy's now, Endeavour Group, EDV, if you're looking for investment ideas. And, seltzers and ready-to-drinks used to be like one little shelf. West Coast coolers, Jack and Coke. And now there's like an entire area dedicated to seltzers, to spritzers, to hard rated. And it's just the options are increasing, and there's health conscious ones, if you want to call it that, like kombucha that's got alcohol in it. And there's low calorie, there's zero sugar, and I think people are just being more health and taste conscious, for lack of a better word. Not everyone likes beer.
Everyone's been binging on Huberman and Peter Attia and just realizing that alcohol's not actually good for you. Shocking.
Zero alcohol is making us.
Alcohol's not good for our bodies? Oh. Anyway, so
welcome to the Australian Health Podcast.
Yeah. But my doctor says 1 glass a day. Yeah. So anyway, that's interesting. So
I have a question for you, actually. Why? Yeah.
What?
Why are you even here?
What do you mean?
WiseTech just hit another all-time high.
Did it really?
Or are you cashing out your billions and walking away?
Oh, yeah, it did. It popped. Jesus. You know what? No, you know what? It was really interesting. I was on a bit of a chit-chat today, and have a guess what Pro Medicus is, the share price. Just have a guess at the share price.
$74.
It's $164.
Oh, sorry. I didn't have any context to that.
I was I'm going to bring it up for anyone that's watching on YouTube. I was just like...
show the chat, hyperbolic.
Let's go, isosceles. So it is, like, if you look at this thing, for those of you that aren't on YouTube watching this, it kind of just is nothing, and then it just goes straight up. How is this even possible? I mean, I'm a happy shareholder. I'm a couple of good articles there too. So I'm a happy. Are you pumping
it? You're pumping it. That's why.
Yeah, what are our articles
Every
actually
company
saying?
that is doing well, you Google it and Rask Media comes up.
But seriously, no, we have to disclose if we hold something. I do own Pro Medicus, have held it for a long time. But okay, then I'll give you another question for this. We're going to go to Dr. Google. What's the price earnings ratio?
Unlimited.
208, which is probably cheap, to be honest.
Said no one ever.
Oh, look at this. Zips is 400 according to Google.
At least it has earnings, somewhat. It's up 7% today too.
You'll take what you can. Don't worry, earnings, it's going to grow into the valuation. It actually could. That's the crazy thing. If interest rates start getting cut and this thing comes back.
ZERP.
It could do
Maybe change the name to ZERP.
Oh, gosh. Anyway,
zero interest rate policy. Yeah.
Do you still hold Zip?
Yep.
It could actually be the player of the year because it is up 700% in 12 months.
Dogs are the ASX.
Yeah. But you basically do have diamond hands, sorry. You're holding it through thick and thin.
Diamond hands.
That's what they say on the street these days.
Larry Diamond, yep.
But anyway, we did have a question come through about Laserbond, which is doing the opposite of what Pro Medicus has done, which is quite interesting. Laserbond is a company that we've spoken about a little bit on the show. Bring it up here.
And we're with lasers.
Well, yeah. We've had Wayne Hooper on the show before. We did the first ever interview, long form interview with Wayne, I believe. Sorry, Andrew Page, but I think we got there first. But this company has fallen from, what's that, like 87 cents, and it fell hard recently.
60%, yeah.
As a result of its results. But one of the big things that they called out in their recent results, so revenue is up 8.7%, but net profit was down 18%. And one of the reasons, which is quite curious about this, is in effect, Laserbond it recently made an acquisition, Drew, and it has to provision for taxes at the group level, but it can't recognize all of its revenue and profitability at the group level. So it's quite a weird thing. But after the third year, Laserbond has the right to acquire all shares in that business, in which case that will be rectified. But I think that spooked people. Like taking a 40% stake in the Gateway Group has actually muddied the financials. I've got a question about this, and the question was, if I do have it in front of me,
Owen, you've liked the company Laserbond for some time. What are your thoughts on the stalling of the growth of earnings per share in the last few years? It just seems like the business hasn't gone anywhere. It is back to where it was pre-COVID.
Yeah, that's a good question. I think...
Good name too. Watering weeds, dumping of flowers. Question name, yeah.
That's a good play on that. I would say that I actually think Laserbond's a very small company, and you ask the question of what does it actually do? What it does is it has these big machines, and they're kind of like the size of like a family van or a small truck, and it's like lasers, and a big piece of mining equipment will go inside it, and it spins on this rotation thing, and the laser repairs the welds and the surface engineering, and that's basically what they do. They repair and they rebuild equipment like that, Drew. But one of the emerging areas of the business, which hasn't really taken off since COVID, it's got a lot of promise. It's been long on promise, a little bit short on delivery, but I've got a lot of patience for this company and who they are. They're actually trying to license the laser technology which they've created. And if that starts to take off, particularly overseas, that will be a huge thing for them. This year, for example, they recognized $2 million of revenue from the technology division. That's of the $42 million in group revenue. So it's still a small part of revenue, but it will be really wide margin. It'll be a really attractive business on a global stage. So all things considered, we don't give recommendations necessarily on this show, but I was actually running around my area the other day, running for exercise, Drew, not for any other reason. And I actually think that it's a small company, $50 million, high risk. Don't buy it if you don't know what you're doing. But I actually would buy these shares today. In fact, I am tempted to buy shares. You get a $3 dividend. It's run by the same family. If Wayne Hooper, who's the CEO, left, I would
3 cent dividend or $3 dividend?
3%.
Oh, I thought you said $3.
Fully frank. Should be fully frank as well. So the price earnings ratio, if you use that type of a thing, 13. I would buy this company, but it's very risky, very illiquid, very small.
Talk about value investing, yeah.
I like it. It's a good business. I like it. But if there are risks, like if Wayne left, I just like having Wayne involved. The business generally is very well run. Matthew Twist, CFO, also very well credentialed and tenured at the business. So that's my spiel on Laserbond. What other companies are making news this week, Drew?
It's been all about lithium this week, and I'm pretty sure. Can you go check? I'm pretty sure Big Mineral Resources a couple of weeks ago, didn't I? I think that was on a 10-year view, though.
Oh, you did? Yeah, you did. No, you said because it was blowing out, and you thought, yes, this is a good business.
That was on a 10-year view, though. Made a good chart there. Yep.
So no, it has.
Look at that bounce. Look at that bounce.
Yeah, bounce.
Can we get a 5-day chart, please?
A 5-day chart? Yeah, it's coming up. So look at that.
Chart on.
Wow, look at that. That's not a chart.
There you go. Yes.
Up 17% in 5 days. Drew, we should start doing this.
I will be honest, this isn't a company. I don't know this company. I don't track it particularly. It's a large company, so you have a close look at it, but it's not something we recommend. but it is the center of news at the moment because you've finally had a kick in the lithium price. I think it was probably a year ago. We, like every other question, was about lithium.
Yeah. Oh,
Pilbara's, the mineral resources, and the massive boom happening in that sector.
yeah. Yeah. We, I think us East Coasters, we call it Pilbara. Pilbara Minerals. Pilbara. Yeah. Pilbara. But yeah, it's been a pretty tough time for some of these lithium businesses. But I could be wrong. Didn't MinRes, isn't going to sell something or do something like this?
Yeah, the big bump came from, there was a major Chinese mine shut down. And this is like, it's a good reminder, not just in lithium, but in any sort of commodity company, that when prices, like we would have been 2 years ago, we're sitting here and there were predictions that the price would stay where it was or get even higher over the next 5 or 10 years because of the shortage. But high prices cure high prices because all the production starts to be feasible and comes online. And it's one of those areas where you need to be careful about what everyone's predicting and getting caught up in the trend. But basically a Chinese mine shut down, a major one, and that boosted the price and had a lot of groups from, I think a lot of their sectors rallied 15%, just on a slight improvement in the outlook.
Wow.
But then Mineral Resources also sold their iron. They also do iron ore. I think they've got a rail or a road. They sold for $1.3 billion to Morgan Stanley, which has given a little boost at a time when they've got a lot of, as we mentioned, I think a few weeks ago, quite a lot of debt at the moment.
Yeah. Okay. So it's a bit of a bounce from the financials. Speaking of bounce in the financials, the Australian Retirement Podcast, featuring the decent Drew Meredith and the Honourable James O'Reilly,
The decent,
recently got up into the top 5 of Apple's podcast charts. Australian Retirement Podcast, Drew, easily the biggest jump of any podcast from a single episode that we've seen. I think it was somewhere between 6,000 and 7,000 people watched it or listened to it straight out of the gates. So that...
Thanks for listening.
Beautiful. Yeah, beautiful indeed. So if you do want your retirement field, there is a link in the YouTube description if you're watching, or that's just below, or if you're listening on Apple, Spotify, wherever you get your podcast, there is a link there. You can go and listen to James. There's one episode a week for the first 10 weeks, and then it jumps into Q&A, guests, that type of a thing.
Yeah. Enter your Q&A.
Yep.
I'll be trawling the internet for it.
Yeah, there's going to be a lot of things going on over there. Anyway, back to the best show in town, which is the Australian Investors Podcast. We are going to do a bit of a deep dive. We did request this, or maybe I just put it out there as a bit of a brain fart, to do a bit of a deep dive into SMSFs or SMSFs or self-managed super funds for people that are interested in a self-managed super fund. Drew, what is it?
This question, the question of SMSFs comes up a lot whenever we're meeting clients or just anyone in general, and a lot of the questions are around SMSF too. As the name suggests, it's a self-managed super fund.
Oh, okay.
Yeah. Next question.
What are the 3 types of that?
No, for superannuation is just this environment, and from a retirement perspective, it is the best place to have your retirement capital, apart from the ability you can't access to your 60. But the tax benefits in superannuation generally just make it the best place to have your retirement capital, or at least the vast majority of it. So you pay 15% tax before you retire, basically zero, with certain limits once you get to 60 and retire. So it just makes complete sense. And a lot of our advice around super, there is confusion that different funds have different rules. There are restrictions, but basically they're all under the same legislation. There's 3 types. There's an SMSF, and at that end, you're able to control and see every single part and be involved in every decision. At the other end, there's an industry fund where you're basically outsource everything. You get what they're investing in. You get a statement every 6 months, and it's very difficult in most cases to see exactly what you're invested in. And then there's something in the middle, which is called a corporate or a platform, and that's things like Mercer is pretty common, or Hub24, CFS, these advisor initiated platforms. So one end you got full outsourcing, like fully outsourced. One end you can be fully tailored, essentially, and then one in the middle that's kind of a combination of both.
So you're saying like Hub's a combination?
Yeah, where you can have control you need an advisor for a lot of the platforms, but you can have control and transparency, and the ability to, influence the investments that are being made, versus having full control and having no control.
So it's kind of like a mixed grill.
And every you must be hungry. Owen hasn't eaten for 3 days.
Just thinking about
eating when we came online too. And as you can imagine, any good advisor tries to work out which super fund's right for which person. So James, everyone, essentially you work out what that person's objectives are, and if they're not suited to an SMSF, you find an alternative. And if they're suited to an industry fund, they stay in industry fund. So it's finding the structure that's suited to what each person wants.
Now, I should know the answer to this question, Drew, and I'm going to put you on the spot and ask you about one of your clients who happens to be my in-laws that I sent to you. I can't remember. I can't remember if because I read the statement of advice. I was like, what's this guy recommending to you? And I read the statement of advice. I can't remember if it was an SMSF or not. But I guess the question is, a lot of people that are in industry funds or have, say, this isn't the case for them, but say, for example, there was $500,000 to $1 million in the couple's name and they're preparing for retirement. Is that enough typically to start an SMSF or to move to one of those hybrid platform things?
I think one of the big things is an SMSF lets you combine you and your partner's superannuation, and kids if you want to. And in that, when you're combining them, you still have your own balances, but allows you to put more money together and thus have more negotiating power.
Uh-huh.
I think historically there was a belief that industry super funds were the cheapest, and the fees used to be 0.4, 0.5% for all the investment administration. Now it's more like 0.7 to 0.8. So it does, in our experience, you really need at least 750 to $1 million combined and increasing to warrant an SMSF for most people, and under that, in combined, you get you can hold. You want to be increasing and still contributing in that case, and anywhere from like 300 plus is where platforms are kind of cost competitive, and that's taking into account 3 fees. So you got an admin fee, which is at the cost of the structure. You got investment fees, which is similar. Your ETFs, it'd be similar on the Rask Invest platform too. You got admin fee, an investment fee, and an advice fee. And industry funds have no advice fee; they just have admin investment. So it's generally that mid balances work on platforms, but also you have to want to have control or be comfortable, or want full transparency to warrant an SMSF in a lot of cases as well. I mean, one of the big things that we're finding with SMSFs is, and this is where people have a fair bit of wealth, they have it in, but there's some in property, some in super, is just the massive flexibility it gives you strategically, and to manage things like contributions and to manage the transition to retirement. And it's we mentioned on the retirement podcast, I think in the next couple of weeks, the challenge with industry funds and platforms can be that if you have commenced a pension, you want to make more contributions, you're opening multiple accounts. You have to have an accumulation account and then a pension. Then you have to, if you roll that, then you can have 2 pensions and then you need another accumulation. So it's fine if you stop and never do anything again. But SMSFs, you can essentially, you'll have those accounts, but you don't have to set them up. There's no process of doing that. And literally you contribute and the fund accountant at the end of the year sorts and tells you which parts in which balance.
Well, actually, it's funny you mentioned that because I was going to ask this question because we did have Elon Musk write in, which is a good play on words, I do say. They said, "Hi, g'day, Owen and Drew. Love the podcast." Mustn't be listening to this podcast, wrong podcast. I listen every week and learn a lot from the questions segment. I was hoping you'd explain the difference in tax treatment between investments inside and outside of super after retirement. Is it the case that outside investments are still taxed at the nominal rate and income from super is not taxed? Any general information would be greatly appreciated. God, they said general.
So superannuation, once you can commence a pension if you're 60 and you stop working, otherwise you have to get to 65. Once you commence that pension, your fund is exempt from tax. You're no longer paying tax on earnings or capital gains. And once you're over 60, anything you take out of super, except very rare circumstances, is also tax-free. So that's why it's the best environment to be in for retirement. Outside of super, you're just subject to the normal marginal tax rates. So as your income goes up, your franking credits can be beneficial in terms of offsetting that. But your franking credit is also included in your taxable income to determine how much tax payable before offsetting the tax. At the bottom, there is something that so when people have larger pools, larger amounts of capital, it can be possible to have a couple of 100,000, so 300,000 or so in direct investable assets in your own name when you're over 65 from memory, because there is a thing called SAPTO, which gives you seniors and pension tax offset, which essentially increases the marginal tax rate that you can have by offsetting tax for people who are over 67.
Okay.
Yeah. So you can hold some assets outside of superannuation, but generally, given the tax is zero inside, it can make significantly more sense, and then you avoid the need to do a tax return in your own name as well.
And this is where I was going to come back to you with that comment you made before. You said that people who have an SMSF, you could have, say, the two parents and say they've got a child or whatever, and you all kind of bundled together, so it brings down the cost because your balance is bigger together. So from an SMSF administration perspective, let's say, I don't know, someone's listening to this and their parents are about to hit retirement and they're in their 40s or 30s. I don't know, this could be a weird situation, but anyway, let's bring it on. In that situation, if the two parents flick to pension phase and they're tax-free, can you still do that if the one that's still working is contributing to the super fund? Does that make sense?
Yeah, of course. It's all like the exempt pension component is calculated as a portion of the fund. So any tax on the accumulators portion will be assessed to their portion of the fund during the year as well. It's and like literally the only thing that needs to be done for an SMSF every year is a set of financial statements. So income, profit and loss, and assets. A balance sheet. And an audit. So an external auditor has to review it to make sure all the assets are being accounted for and that those assets are being treated appropriately and the pension assets are being treated appropriately. Okay. That's literally the bare minimum that needs to be done.
I've got one more question. So you're saying like you would prefer Wattle Partners for them to be, above $500,000 of assets combined. There's been various reports that people try and get them. I think the reason that SMSFs get a bad rap is because people get into these quote schemes, Drew, where like they'll go and meet some property developer from Southeast Queensland who's like, yeah, you should buy this off the plan and here's someone's going to set it up for you.
We love Queensland, by the way.
We love Queensland, good son. Going up in about 3 weeks. But you do get a lot of off the plan type gurus up there that set up these kind of, I would say, crooked property first, SMSF second type strategies where they're like, you just want to buy a property, you can use your super fund to do that. When really it should be the other way around. Like you've got a super fund and property just so happens to be an allocation that you want. But do you think that, do you get worried that there's people with $100,000 or $200,000 SMSFs?
As long as they're aware of the cost and on top of the cost, I think it's like SMSFs can be fine. And there are some lower cost ways to do it. I know there's a few platforms that are offering lower cost options, but they are very suited to people who have a real interest in managing their investments or at least being involved in the decision making. It does worry me, and that's the first thing. There's another episode where we talk about, what you should be aware of an advisor. If it feels like every solution is property in an SMSF, it's probably not a comprehensive or a broad financial advisor. The bigger question there is that the type of asset you want to hold in superannuation? If it's probably getting too specific, but if your most property is negatively geared or close to negatively geared, you're not really getting tax benefits if you're only paying a tax rate of 15%.
So kind of you might as well do that outside super.
Yeah, exactly.
Okay, so Aussie Clark Kent wrote in and asked a question which was related to this because they knew that this was coming.
Good names this week.
Very good names. Keep them coming. Hi, Owen and Drew. Thanks you for your great podcast. I think they might have meant Kate's podcast. My question is something for your upcoming quote-unquote special on SMSFs.
We've got something to talk about that too.
I understand that the general tax rules apply the same to all super funds. I also understand that for an SMSF, capital gains tax is paid in the usual way, like when you sell an investment, you incur capital gains. this is the technical question, which I don't know the answer to this. So I don't even know if you know the answer, but we're just going to put it out there and see what happens. Do members of large industry funds like Australian Super effectively pay CGT even when the assets are not sold due to the fund's provisioning for future CGT? The Australian Super website states, when you have a super account or transition to retirement income account, Australian Super sets aside money to pay for future capital gains tax when investment assets are sold. Does this mean that members of the Australian Super Fund are missing out on compounding that money that is set aside? Does this also apply for the member direct options? What I am wondering is whether this is a benefit of SMSFs, that there's no provisioning for SMSFs in this instance. So basically the question is that provisioning for capital gains is incredibly technical, and I don't know the answer to this, Drew.
I mean, it's the yes to SMSFs. You're completely able to control and exempt everything. Whereas industry super funds are pooled, so you're pooled with other investors in a unit trust. So, and as I said, there's a reasonable article up here, which is that the pool super fund estimate the value of the units every day, and transactions that are occurring in there you basically reduce the value of the units if it's paying capital gains, is my understanding. Capital gains tax liabilities are deducted even if you haven't sold any units, is how I believe it works. I'm happy to be
well, the thing is, this is the whole thing.
It's not like even when you sell your units and they're at a higher unit price, it's within the units.
This is the thing. Even if you wanted to find the answer to a question like this, I think it would be quite difficult to actually get the answer, because you don't, like, the accounting policies of different funds. Remember, those big super funds are unit trusts that are invested in other unit trusts or other things like illiquid assets, like entire buildings. So I vaguely remember reading something about this a couple of years ago, but if someone knows, they can write into us, courtesy of Clark Kent's question here. It's a good question. But basically the question is, like, do you get more control in an SMSF? And the answer is yes, you do. Yeah. And the tax treatment's the same as you said at the top.
Very clear.
Yep. Okay. Now we do also have some not related to super questions, which we could probably get to, Drew. Now, I should also say, as always, that any of the questions that we answer on any Rask podcast, even the bad ones like this one, is strictly general in nature. We don't know your personal circumstances, your needs, goals, objectives. So be sure to speak to a financial planner like, say, Drew here, or Jamie from Waddle Partners, or whoever you can find and verify on the Money Smart website. Go and speak to them to get them to take into account your needs, goals, or objectives. And if we talk about things like super funds and whatever, they'll have a PDS, which you should read before acquiring or investing in that product or service. We have an FSG that is available on our website. It's a financial services guide, rask.com.au/FSG. Drew, I would like to start with the easiest question of all.
I do have a bone to pick with you first.
Okay, here we go. Brody, what is it? What do you got?
Have you read my book?
Yep. I was actually trying to find it before. I couldn't actually find it. And I was like, I knew this question was coming. I don't know what I've done with it.
Our prep for this podcast is in a shared notes folder on iPhone. And my first question was, why wasn't my book in your top investment books when you filmed the Australian Finance podcast this week? As you go for a crossover, it was very sad.
So Kate Campbell, the daughter of the Campbell soup fortune. Just kidding, she's not. But we did an episode this week for like top finance books or something like this, and Drew's book was not mentioned in there, because what I did was I actually just looked around. I panicked. I was like, what can I just look on the shelf behind me, and your book was not there, and then I realized it's probably in the office. So apologies for that, mate. But no worries.
Sorry, rudely interrupted. Back to the question.
The question I wanted to ask you comes from Powdered Toast Man, who writes in and says, my question is about investing in unlisted / listed private equity funds.
So stitch up.
There's been a lot of discussion around this topic over the past 12 months. Roger Montgomery recently stated, in his view, this style of investing would significantly increase over the coming years due to the aging population and retirees hunting for higher yield. Roger went on to suggest that this investment vehicle would produce higher than 10% annual returns. This is all in the question, by the way. I'm not making this up. This was an investment in debt. Sounds too good to be true. Is this a viable investment for retirees? What are some fund examples? Says Powdered Toast Man. Now, I actually have no idea what Roger was referring to. I don't know where this was said. So this is literally coming from the questioner. True?
I mean, this probably goes back to the lithium kind of story at the beginning. And this
Tell
is
me
the... How do you link these together? Yeah.
yeah. Take us on a journey, son.
The thing about financial services is that there is, very powerful marketing behind a lot of different products. There's ETFs if it's funds, if it's this, if it's this. And it's similar in lithium, that it wasn't marketing by the lithium companies, but rather the sentiment and the headlines were forcing people to consider lithium because it was doing so incredibly well.
Okay.
And it happens in every part of the market, and probably, and I believe this question mentioned private equity, but I'm pretty sure it's actually about private credit. And it isn't just RM, let's say RM.
Roger Montgomery.
There are probably 100 private credit groups in the market at the moment, and private credit is just direct lending in multiple ways to corporates, Australia, all kinds. It doesn't have to be to corporates, it can be all kinds of things, as I think you've covered multiple times. But it is this idea of marketing a story and also having a solution to invest in that story. So private credit as a sector has been used by pension funds, sophisticated investors for a long period of time. But it doesn't mean the private credit you're getting as a retail investor is the same for that, nor does it mean it's suited to everyone. Nor does it, when someone says I expect returns to be this, nor does it mean that's actually what the returns are going to be. So I think, like everything, it's always a grain of salt. Review the asset class. What are your objectives as an investor? And what's the appropriate tool to invest into it?
Yeah.
Is the most politically correct way I could answer this question.
Well, you did take us on a journey. You did take us on a journey there. I actually think I've found where this may be coming from.
And it's not a specific, this isn't saying his product is good or bad. That's not saying that. I've never looked at the product, but there are a lot of them around, and it's kind of the popularity of an asset class and the marketing towards people investing in those asset class, which a lot of it is about education as well.
Yeah. I just went in search of this, and I can see an article on the Roger Montgomery website that it's called.
I feel like you're going to be less politically correct.
It says, no, I'm just reading verbatim what it says here, Drew. It says, private credit, a smart choice. This is on September 9th. And then it says that it's just a video update for this Aura private credit income fund. The fund has outperformed the stock market with zero volatility, providing a 9.64% compounded annual return over 7 years with no negative months, including during COVID. So basically...
there's a thing in markets, zero volatility.
I know, I was thinking about that.
That's not just the same for them, but if you're not repricing something, there's the only way that there's no... Yeah, I won't expand on that.
But it says, this is probably the bit that I just wanted to educate people. It says here that the Aura Private Credit Income Fund is an unregistered managed investment scheme for wholesale clients only.
Yeah.
And it's issued under an investment memorandum. This is important to understand. I think this is probably an educational thing that we can take away from this, is that when there's a product in Australia, there's two categories of investment funds. There's one that's for retail investors. They must come with a PDS. That's why when we say there's an ETF through the stock exchange, and anyone can buy that. So that means it's what we call quote unquote retail product. And that means it has to have a PDS, which is like a disclosure document. It says, here you go. These are the risks. These are the fees. These are this. These are that. For certain other investors, they can qualify to invest in something called a wholesale fund. And typically a lot of the private equity funds and the private debt funds are wholesale only because they're not always as easy to fit together. And ASIC, the regulator, might look at them and go, hold on a second, that doesn't really seem like it's for the majority of people that would be able to invest in that. And so typically those types of funds have a higher minimum, typically $100,000 or $250,000 minimums, sometimes more. But the key thing is, and this is the key thing I want people to understand, is they don't come with the same amount of disclosures. Now, this is not in any way a knock on this fund. I have no idea what it is. But most of the funds that I come across are like this. And it does actually make sense that you would have a wholesale fund for a private credit vehicle. But the key thing is like just understanding what you're investing in. I think a lot of people, when it comes to private credit and private equity, Drew, at least in like the direct investor space, which we represent, don't truly understand these things.
They're over the counter, they're unlisted, they're illiquid.
Yeah. And you can then
assets.
we don't know this one in particular, but I see a lot of these. And we had someone we had Dean Price from Washington Soul Pattinson on the show recently. He's the head of private credit at Soul Pats. And he talked about the risks and the different things that you can look for. For example, he said that they'd never lend basically to a business that has less than 30%, has more than 30% gearing in that business. And so it really depends on the end exposure that you're getting and how you're getting it. We had Ashley O'Connor from Invesco on the show a few times. He talked about senior secured loans. So he talked about private credit that was at the top end of the risk spectrum, meaning that he was at the good end, the lower risk. And you typically get higher yields from these things. But one thing you typically don't get is growth. So that's another consideration to keep in mind. And what I would say is 10% over the last 3 years is probably about right for depending on some of these private credit funds, Drew.
Yeah, you want to be insured for every investment. You're being rewarded for the risk, and to know you have to know what's underlying that pool of assets. And the biggest risk in credit is a default, and a default in a loan, a lot of the times it would go to zero, like a proper default, which means they have to call. And that's one, I think, an area that the return is capped at the interest that you can receive, but the loss can be down to zero. Not that happens very often. And I think private credit's in the paper every day at the moment, and it's very much questions about the quality of the underlying borrowers, which can be hard to determine, and how those groups and companies and assets are performing in an environment where interest rates have gone up significantly. So make sure a lot of private credit will be floating rate, which means the same person was paying 5% interest 2 years ago, they're now paying 10 or more. That impacts a business quite significantly. And we haven't really had a recession in,
30 years.
30 real recession in 30 years. So if that happens, how are these businesses and assets going to perform? And are the lenders used to an environment where they have to deal with defaults?
And that's the thing.
Credit level.
So that's where it's like different for an ETF. If you're an ETF investor, even if your ETF is a dud and it doesn't do too well, you can always sell out. They're very well regulated. They're highly liquid investments underneath them. But when it comes to private credit, you're basically lending to businesses, or at least you're paying someone who then lends it to businesses. And what are they going to do? Like, they can't just pull the money out straight away. That's the whole point of them. So you just got to be aware of those risks. If you don't understand it, just do not go anywhere near it. And if your financial advisor is willing to put you in them, they should be able to explain them in very, very simple terms what's happening, and they should have a strong understanding of it. Now, Drew, there was a bit of a fun question that's come through rather than those sticky ones. This question comes through from Holly, who writes in and says, I have $100,000 to invest. Now, I'm not going to go any further than this because I want to keep this as a bit of a fun game. I want to, Drew, ask you a very simple question. It's in the headline for today's show, which is, if you had $100,000, what would you do with it right now? Now, it doesn't have to be an investment. You could just say, I'm going to go watch the Western Bulldogs lose to Hawthorn again. Or
I was waiting for that one.
Or it could be something else. But I'm curious, like, what you would do with $100,000 if it just dropped and $100,000, there we go. What would you do with it?
I've got my eyes on a car, but that's probably not the best.
What kind of car? Tell me. F-150?
Well, not far.
Cybertruck?
No. I'm not anything that big. The new Toyota's coming out.
What's that?
Prado.
Finally, man.
But that's not what I'd recommend. And I'd also one day like to have a hut in the middle of nowhere, but that's
A hutch.
It's going to be more than $100,000. So aside from paying down debt, I'd honestly be buying some offshore, some Aussie and some offshore shares, to be honest.
Offshore
yeah.
shares. Try to say that too quickly.
Don't bring up the front. There's already a wait list. We don't need anyone else looking at this car.
Oh, look at this. It looks like an FJ Cruiser, if I'm being honest. Gosh. So you would call this an investment?
Yeah.
Okay.
You said, what would you do with $100,000? Well, there you go. You probably finance that, and it's a work vehicle. So more broadly, I'd probably get some. I'd basically be buying equities at the moment. I wouldn't be buying cars or property. I'd probably mix up some global, US and probably international shares. So get something indexy and some global small caps. So 2 investments over there, and then pick the eyes out of some pretty quality Aussie companies.
So you would pick the eyes. Got that? Yep. Global.
Yep.
You said indexy.
Indexy, yeah, but not fully indexed like Sang.
I'm going fully indexy. So you're not fully indexy, but somewhat indexy with a wink. Yeah. Like indexy. I get what you mean. Global small caps.
Yeah.
Yep. Okay.
Like global smalls.
Global smalls. You like global smalls?
And I kind of like
picking the eyes. That's what I've got as the third one. Okay. Yep.
Kind of like infrastructure at the moment too.
Kinda likes infrastructure. I'll put that down as kinda. Infrastructure.
So diversified portfolio is, you say you have 3 pools, some global, all growth, global equities, domestic equities, real assets and infrastructure. I'm going big tech and global and small caps, infrastructure and real assets. And I'm doing a bit of a mix of quality in Aussie, to be honest.
Would you go big tech? Would you go like FANG or something like that if you go an indexy? Or you already you're FANG heavy?
S&P 500.
S&P 500. Okay.
Yeah.
Okay, just writing this down. It's just fully.
I'll be buying some Pro Medicus and nah.
We actually had that interesting question last week about global small caps and names like Ausbil, Fairlight. What else got brought up? Munro, was it Munro?
Munro Chow Ma runs the
Yep, we're actually catching up with Chow Ma.
Yeah,
Chow Ma's coming up on the podcast the next couple of months.
Yeah.
Thanks to you, Drew. You know people.
Yeah.
Shout out to Chow Ma.
Portfolio stocks. Let's get some quality in there.
Let's get some quality in there. Okay.
Yeah.
All right. I like it.
Wesfarmers.
I've got West
CSL, Cochlear, Macquarie.
Oh, good picks.
Yeah. Maybe not.
CSL.
CSL, ResMed.
A bit of a healthy portfolio, no pun intended. Okay. My question was actually more around not the Cybertruck, take that off. This kind of infrastructure and real assets. How would you get that exposure? If you only had $100,000, that's not enough to go into one of those exotic type funds. So how would you do that? Would you go to a managed fund, unless a managed fund? Or
managed fund or BlackRock. Or BlackRock, or there's a couple of, not BlackRock, there's a couple of ETFs. There's a couple of infrastructure index ETFs that do infrastructure or real assets, global property.
Yeah.
I combine both.
Yep. Okay.
So a bit of index, bit of active. I mean, you look at infrastructure, underperformed for a couple of years. Bond yields have gone up, debt levels have gone up, distributions have been difficult, but we're not consuming any less energy and shifting more energy and electricity around as much as we ever had. And then things like data centers can fall into there as well.
Okay. So and you were saying global infrastructure.
Yeah.
Is that because it seems like you're interested in a bit of
GLIN?
Oh yeah, Glenn. Yeah.
Yeah.
Yeah, that's a beta shares thing, is it?
GLIN is BlackRock iShares.
Oh yeah. Yeah.
Fairly new.
Oh yeah, cool. Okay. So that's interesting. Yeah, I would probably indexy. That's cool.
Indexy.
I think global small caps, good active funds in global small caps is something you could probably always have in your portfolio, to be honest. So I kind of agree with you on that one. I actually do like all of those names except CSL. I think it's a good company. I just don't think it's the company it once was, to be honest. I would buy Wesfarmers. I think that businesses like Bunnings and that are just a stellar business. Macquarie is a wonderful business. I just wish I'd bought it at any time in my life. I have never bought Macquarie, and I would probably buy shares in that. I would put a little bit of money if I had 100 grand into Laserbond, but it's very small. So people, I'm talking small amounts of money here. This is not, what's that show? Jim Cramer. We're not the two Jim Cramers of Australia. So we're not
Squawk
out
Box,
here,
isn't it?
we're not out here hot money, whatever that thing is. We're not out here just flinging stock ideas at you. But, like legit, I would actually consider putting a few little satellite positions in. Don't really care for infrastructure, if I'm being honest. If I was a retiree, I would probably take that 100 grand and put it straight into super, either as a non-concessional contribution or as a catch up on the concessional contributions. If I was closer to retirement and had the right, if I could actually use the catch up allowance. But yeah, what actually would I invest in? I think you're bang on the money. I think having some US global exposure, some small caps would be fun. Do you have any? Here's a question for you. As one of my guests said to me last week, I think it was. What was it? So that was I don't know, out of context question or something, and they refused to answer it. Would you, or do you currently have in the Waddle Partners models that you do with Atchison? Do you have Aussie small cap managers in there?
Yes, we do. Yeah.
Oh, okay. And so is that a regular feature, or is that something that you turn on or off?
I think Aussie, given the valuations for the last kind of 5 years, that small caps have been undervalued, and kind of the long-term history, and then looking at over the long term, active small cap managers have outperformed their benchmark. If their benchmark hasn't done well, it's another story. I think they just they're a stalwart small caps, at least for the last 5 years, where there's been a valuation differential and the ability to outperform significantly. So they have and will remain in there. I think when it gets toppy, which isn't, valuations are high, kind of like probably during some of the tech sector during the pandemic, that's where you have some concerns about small caps as an allocation. But I think they should be home of every portfolio because of the growth and the diversification in terms of sectors, companies, parts of the supply chain they bring.
Fair enough. Now, I should actually say that if I had 100 grand, I personally wouldn't put all my 100 grand into super. If I was older, I would strongly consider it, but I would just dump it all straight into Rask Invest and maybe just leave a little bit over for the individual stocks. We don't have any global small caps in our portfolios, but I would like to add that in. It's just hard when you're on the listed products, but I'm sure more of them will come to market in the next few years. There was a question in here, Drew. It was about the misunderstood. So Toe in Murky Water writes in and says, I hope I didn't misunderstand. It's actually a very good clarifying question. I've just started buying ETFs and am still learning. You mentioned in this week's podcast that you wouldn't buy IVV. You would rather buy Australian managed funds. I recently put my toe in the water and bought IVV, VEU, MSCI. Don't know how that works. Was this an oops moment? So we don't know. We can't give you personal financial advice or anything like that here, but I can tell you for sure that we own IVV at Rask and are very proud owners of that, particularly with recent currency movements. We're very proud owners of IVV. We also own IHVV in a smaller allocation, which is the hedged version. So I don't think you misunderstood. But it may have been the old VGS versus IVV debate where you took the side of VGS and I did IVV.
And it's all personal. Yeah, exactly. You might have talked about, US listed ETS versus Australian listed. And you generally want to buy the Australian listed because there's IVV overseas and IVV here. And there's obviously all the tax and reporting issues that come if you buy the overseas one. And then it's just all personal opinion and personal objectives. I preferred the greater diversification in BGS, and you preferred the pure index that you get from the pure S&P 500 that you get from IVV.
Yeah, so you can
each their own.
Team Drew or Team Owen, you take your pick. Let us know in the questions for this week. There was another question to come through from Drew the Pensive. It says, thanks for the golden years, Drew. and it has an asterisk, which I think goes to a footnote that says not so much. Halfway through, but as someone still in their 40s, should I maybe be buying Happiness First with Kate Campbell? Interesting. First, quick question. Your podcast picture has the ASA logo, but you haven't mentioned them for a while. Can you remind us what they do? Absolutely, we can. The Australian Shareholders Association is a long-running partner of Rask, and we are so delighted because the ASA, Drew, as you know, actually is one of the great relationships that we have, because we, in effect, are able to get CEOs onto our podcast series and hear from them. And in return, the ASA is able to share their network through Rask. And it's actually a great thing. And one of the things that's really great about it is that we are able to sell tickets. We're able to offer you ASA memberships. But the ASA is Australia's biggest organisation, and it keeps companies accountable. If you've ever worried about corporate governance or those types of things. And I just, this afternoon, it was only 1 hour ago, Drew, I received an email from the head of marketing at ASA, and they say, I'll keep her name out of it, but she said, I hope you're having a lovely week. We have our Virtual Investor Summit 2024 on the horizon. There you go. So the Virtual Investor Summit. So typically every year the ASA does 2 massive events. They did Melbourne this year, and they do an online event. So the ASA is a wonderful organisation, and I'm proud to support them. But they go on to say, my main question is, could you share your constructive criticism or roast-style comments from glancing at the other presenters' portfolio? What things look weird or strange or has done well?
Whole thing.
Is a big or small proportion?
Why do you index and pick WiseTech?
Mate, have you seen bloody Richard Whiteman? So from my, and they said, thanks for the that book that you sent through, because they went under the name Dingoes of the Dow. And they say, why does a duck have feathers? Cover off its butt quack.
Yeah, I didn't know. I think I used that joke a few weeks ago. I got an even better one here.
Okay, well, you're going to have to ready that in just a sec. I think what we do, you and I, is we do kind of take the mickey out of each other a bit. Like, you've got Zip, I did have Dubber. How's Dubber going?
We should pull out our whole portfolio. I think that's what they want.
Well, you can see mine online.
The Dome did that, I think, recently, didn't he? That's what people have enjoyed.
Oh, did the Dome really do that?
Yeah.
Just so we're all across who the Dome is. That's Luke Larrity. He refers to himself as the Dome. Is that
apparently Lake Como?
Is he really? God, he's probably going to come back with a polished dome. 3.4 cents.
Yeah.
Dubber is ST Rugland. Yikes.
You're going to take that out of the Zip story now, I think.
I think that you've won. I think you've won.
No, there's no winners in this. Let's be completely honest. There are no winners.
Well, I don't know. Zip could come back, mate. I don't want to, like this. The questioner says to roast each other, but you're at $2.26. What was your blended average price for Zip? Like $6?
No, $2.
Oh, so you're in the money.
I reckon I could find that. Yeah, I think so. I'd have to fact check that. Fact check myself.
The ABC is going to do like one of those things.
Might be where I put it in my head.
If it just gets back to $2, I'm only 50% down.
Do you include the profit I made the first time? Probably not.
Oh, probably.
Should then buy back in.
So $2.26, it's up 700% in the last year. Like, it's obviously come off a bit of a low point, dead cat bounce and all that. But if it goes up another 700%, Drew, it'll be back at $14.
Then we're golden.
You've retired. You've got your golden years ahead of you. Gosh. Okay. Well, that's pretty good. I don't really have anything else to roast. Maybe what we do is we do a bit of we create our own little miniature portfolios, and then we just roast each other based on what we pick. Next
week, I'll pull 5 investments out.
Okay.
For you to have a look at, and maybe with a little bit of prep so we can go deep and ask some real questions.
Okay. Yeah. Oh, these are real questions. Okay, that's great, mate. Now, you're going to have to ready your dad joke, but I'm going to have to pick a questioner for this week. And thank you for taking us through the SMSF journey. There were some really good questioner names this week, including Elon Musk, which could be a play on, obviously, Elon Musk, but Blusk being the former name of Flint Group, who's our mortgage broker. Holly just wrote in with the same sort of name. Actually, there was a question for Dome, Too Big to Flail, and they asked if we could ask Luke about Webjet, because Webjet's come out and said they're doing a demerger and they've given every ASX investor 100 pages to read. So maybe we'll get the Dome onto that when he gets back from Lake Como. But I think the Aussie Clark Kent, if you were Aussie Clark Kent or Elon Musk, I would love for you to write in. You've scored yourself a free value investor program with Equity Mates. That's our newest value investor program. It's one of only 2 courses we actually charge for at Rask. Hey, Drew, I didn't tell you this. This week we enrolled our 30,000th.
30,000.
It's like a TH on the end there. 30,000th student. So we are well on our way to 100,000 in the next few years. So if you want to help your family and friends, your school, your workplace, we have loads of courses that are free, and it is our mission to get to 100,000 in the next little while. So please share the courses. You can actually take valuation courses on there. There's the Value of Everything course, which is free, and also the original Value Investor program from 2020. That's also free with valuation templates, spreadsheets, DCFs. All that stuff is all freely available in there. So Drew, that's that. If people want to get in contact with you, they can meet you in California. You'll be walking around in a pink t-shirt with a mojito, and that'll be the guy. That's the one right there. But you can also get in contact with Drew by following the link in your show notes that says financial planning, or send an email to drew@wattlepartners.com.au. Drew, you've got to send us off. Smooth sailing for Saturday, by the way. You'll be in the air by the time I listen back to this, or most people listen to this. Smooth sailing. Enjoy the junket. We look forward to hearing from you live from Huntington Beach, California in the Future Proof Festival. What have you got for us? This could be your last dad joke.
Knock, knock.
Who's that?
Cargo.
Cargo who?
Nah, mate. Algo who. Cargo beep beep.
Oh, that is...
Yep, I think I've got him. I think that's the most you've ever laughed. That's a great one.
That's a good one. Because at the same time as you said that joke, and you executed it flawlessly, well done, sir, I was reminded of an episode that I did with Reg over on the Australian Property Podcast this week. And he said, Drew's doing pretty well with his dad jokes lately. You got to let him know.
I'm going to bring some to retirement next. That's the one thing that's missing.
James will love that. Yeah. No, mate, this has been great. So if you were Aussie Clark Kent or Elon Musk, right into us at Rask and you get yourself a Value Investor program. You can head to wattlepartners.com.au, and also don't forget to subscribe and do all that sort of stuff. But we need questions for next week. Send Drew your junket questions, and maybe send some questions through about different ETFs or companies you'd like to take a deep dive, or even topics like SMSFs. Last week we did emerging markets and so on. Drew, absolute pleasure.
Incredible.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.